Welcome LinkedIn, YouTube, and Twitter to Showcase Live, which is all about having professionals within their respective industry share their ideas, insights, and strategies. My name is Michael Wardy, Certified Financial Planner and Regional Director at Source Advisors, and thank you for joining. To our audience on YouTube, LinkedIn, and Twitter, if you do have questions or comments, please, throughout the broadcast, feel free to share. Many investors in 2020 fared out fairly well within the markets. And now that we're in the new year, the question is, what's next? And that's why I've asked Andrew Hodges with Value Investment Professionals and Lenny Linsker to join me today to give an overview of some investment ideas for the upcoming year. Gentlemen, welcome.
Thank you for having us.
Thank you, guys. So before we get started on what everyone is really itching to know about, investment ideas, Andrew, can you please introduce Value Investment Professionals?
Love to. So Value Investment Professionals is a New York-based registered investment advisory firm. We offer financial planning, investment advice, and estate planning services. I founded Value Investment Professionals approximately 9 years ago with the intent to provide personalized service akin to what you'd find at a wealth manager, combined with the level of investment sophistication that you'd see more often at a more expensive buy-side shop. This service is not unknown to the market, but it's frequently reserved for dynastically wealthy families who have in excess of $50 million. So we're delivering this service to people who still have a good deal of money, but under the dynastically wealthy level. So, and it's been quite a year in the stock market. If you looked at the market, you'd never know that 2020 was a rough year. This type of activity may have been due to some government stimulus. Michael, do you want to throw in that first slide?
Sure. Let me do that. Let me give a better view of it. There we go.
All right. The slide that Michael has just put up there is assets owned by the Fed, essentially. And what this shows is, historically, for example, in the Great Recession, the government was stimulative. But after that, they continue to be stimulative. And this year, it just went hyperbolic all the way up. And so there's really a question of whether the government and central banks have pumped up financial markets. But you might wonder, is this just in the United States? You want to flip to the second one?
Sure. There we go.
And the answer is no. If you look, at the Bank of England, in Europe, the Bank of Japan, the major economic powers in the world have all drastically expanded their balance sheets. And we've commensurately seen interest rates falling and falling and falling. So the next one. And so we know that the market ended at all-time highs, and consequently, valuations are towards the absolute top of their historical percentiles. If you look at traditional and anecdotal macroeconomic indicators, most of them are at or near their all-time high. That doesn't mean the stock market can't go up, though. You want to go to the next one? If you look at Wall Street, the consensus in Wall Street is stocks are going to continue to go up. The expectation for government stimulus is that it will keep on flowing. The expectation for interest rates is that they're going to continue to stay low. No one is quite sure what's going to bring us down right now.
So,
go ahead.
I apologize for interrupting, but I wanted to ask, when you look at the levels that they're at, and I know from my limited knowledge, because I haven't been in the business in a number of years, you look and you say, it's got to start going down. We've seen in 2020, I know we saw blips of that. What are your thoughts on that? Do we see that there's going to be some major fluctuations?
Well, I once read that there are no new eras and excesses are not permanent. My experience is that valuations do not matter when a bubble is inflating, but they matter a lot as it begins to burst. So, so then the question becomes, what would bring this down? And the events of 2020 didn't, and the will within the government is to not allow it to go down. So I think it's highly uncertain. And so what a prudent investor would do is review their financial plan and diversify. For the long term, stocks have almost always been a compelling place to be, particularly if you look at a 30-year period. Even if you invested the year before the Great Depression, stocks were the best asset to be in over that 30-year period. So, as you're saying, value out there in the market, and maybe it shouldn't have a very strong correlation to traded securities. I think the answer to that is probably real estate right now, and I don't mean to say real estate's cheap. I just think tactical people can purchase at reasonable valuations, and this whole money supply issue with low interest rates creates an opportunity for attractive leveraged returns. And on that note, I'd like to introduce a friend of the firm who I do deals with from time to time. We recently closed one in upstate New York. Lenny, why don't you take it away?
Thank you, Andrew. So I bought my first apartment building back in 1987, and then my first shopping center and warehouse in 1988. And back then I was doing deals roughly at 10% pre-leveraged returns. So let's call that a cap rate. So basically, $1 million deal would have $100,000 net operating income. And back then, the interest rates that I was borrowing at were roughly 9 or 10%. Seemed to make sense. Now, I'm still looking at deals with 9 or 10% returns, pre-leveraged returns, but the cost of capital, the cost of debt has come down from 9 or 10% back in the 1980s to roughly 4%, which seems to me to just be unreasonably good returns. In my 33 years of doing this is the best time ever that I've encountered to be buying real estate. You can't just buy anything, and there's certainly competition, but the returns compared to the opportunity cost of putting the money into bonds at a couple of percent, or stocks, as Andrew said, which seem to be kind of frothy right now, are wonderful. Andrew and I can discuss some deals that I've done, some deals that we passed on, because you can't just do everything.
Sure.
But my expertise is in mostly shopping centers, warehouses, and also apartments. Never did anything with hotels or raw land, and I never really liked offices. And that's probably a good thing these days, since who knows what the future of the office market is. But that being said, I'm sure that there are, for strategic investment purposes, good office deals to be had. So what I've found is that my sweet spot seems to be roughly between 2 million and 15 million in purchase price. Under 2 million, and you get too much competition. A lot of people can do $1 million deals. There's a lot of money floating around. There are doctors, lawyers, accountants who have, let's say, $250,000 to put into a deal. They can borrow $750,000 from a bank and buy a nice little apartment building or a standalone Family Dollar. So I hate competition. So that's not for me. And interestingly, above 15 million, there's a tremendous amount of competition as well, from institutional investors, from REITs, from private equity funds, and they just have a lower cost of capital and lower return hurdles. So I can't compete with a pension fund that's looking for a 5% return. I don't want to be competing with them. So above 2 million, and not every doctor, lawyer, or accountant is going to be able to swing the deal. And below 15 million, and the REITs and the other institutions probably aren't going to be that interested because they want to be able to write big checks to deploy big money. So between that 2 and 15 is absolutely fine. There's a lot. But unfortunately, I'm based in New York. And in the New York metropolitan area, there are too many people like me. There's too much competition. So
you said you don't want competition.
I hate it. I hate it. So I don't do many deals in the New York area anymore. The last deal that Andrew and I did together was about 4 hours away in central New York State. It was a 50,000 square foot shopping center, 3 national tenants, all essential services. They were open throughout the pandemic. Public companies with multi-billion-dollar market caps, with all of whom have been there for, I think the most recent tenant came there about 15 years ago. The other 2 were there for roughly 20 years each, and they all have good lease term left. And it was a 10% deal, actually a tad more than a 10% unleveraged return. And we got non-recourse fixed rate financing for 15 years at 4%. Now, if you had told me that I could be borrowing at 4% if you told the old Lenny back in 1987 that Lenny in 2020 would be able to borrow money at 4%, fixed rate for 15 years, non-recourse. Remember, back then I was borrowing at 9 or 10% recourse. I would have thought that you're crazy. I would have bet against you. But it's a wonderful time.
So, just for the listeners out there, what does that mean when Lenny's talking about a 10% unleveraged with 4% leverage?
Mm-hmm.
So if we're borrowing 2 to 1, 10 minus 4 is 6, and we're adding that onto the return twice. So that means we're getting 10 plus 12, we're getting a 22% return with stable tenants who are, selling defensive goods, attractive. It's in the middle of a town where, the middle of the town is stable. The outside edges of the town, I don't know. But in our area, our specific one, it's okay. And so I think that's an important, and if we compare that to stocks, once again, because, I'm not just a real estate guy, value investment professionals, we're looking across the spectrum to get an expected return in the 20s, and the property could go up in value. I'm not even counting that yet. Mm-hmm. But to get something in the 20s, you'd probably have to buy a speculative technology stock and hope it keeps going up and nothing bad happens. So to speak to Lenny's point about investing defensively and now relative to the 80s.
So, thank you, Andrew. That was important. I didn't take time to explain the real returns to us because of the leverage. But yeah, when you can borrow at 4%, the arbitrage between the 10% return and the 4% debt is tremendous.
That is. And when you guys look at real estate, because Lenny, like you said, there's a lot more people that are coming into the market under that 2 million people. There's a bigger pool. But when you guys look at real estate, you look within that portfolio real estate or that investment property that you're looking at, you look at what type of business the tenants are in as well, not just where the property is or what the value is, the price is. You're looking at truly what the tenant is, because you want to know that that business is going to be around for longer than what you're going to own it for.
Certainly. Well, although my typical hold period is forever. That's my ideal hold period.
It's a good period.
There's an old saying that typically the biggest mistake made in real estate is to sell. So I'm looking to hold for a long, long time. And yes, of course, the tenancy is important. The credit quality is important,
Mm-hmm.
Especially, of course, nowadays with retail. You have to be very careful. I wouldn't want to be buying a standalone Bed Bath and Beyond.
Mm-hmm.
They're not the same company they were 10 years ago.
True.
So you Amazon is a real factor. That's why I do like shopping centers with dollar store tenants, supermarkets, that sort of thing. I like warehouses. Um, so
Mhm.
it's real estate is very unique. Every deal has to make sense on its own. There
What
are
about
no.
medical buildings?
I'm sorry.
Medical offices, medical space?
That would be fine. Andrew and I looked at a medical office building a while back in New Jersey, and also one in
In Ohio
Ohio.
too, just recently. And
Yep. Yep.
to speak to the difficulty of screening something on a specific level, uh, in the Ohio property, it was marketed as medical because it was right around a plethora of medical facilities in the Cleveland area, which is an area where my family's from. And so we knew it, we visited it. And really what we found out is that the landlord had taken something that was low quality office located off the road, was trying to get medical people in there. There were doctors who were retiring with an unclear path to what was going to happen afterwards. And the guy was stuffing low quality tenants into the space, and then he was trying to sell the rent to us. And when you buy real estate, there's some assumption that it persists, and that's embedded into the price. And so it really highlights the value of having somebody who's going to do thoughtful diligence.
Mm-hmm. That makes sense. So I do want to add Anne Liebgo, and Anne, I apologize if I mispronounced her name on LinkedIn. She did mention, I don't know if we want to get into this, but you, Lenny, you had mentioned, and Andrew, you had also just mentioned about portfolio diversification, not outside of New York and more geographic region. Do you guys ever deal in international, or are you guys still focused on domestic real estate?
Purely domestic, but
Purely.
but on a national basis. Probably one of my best deals in the past few years is in North Dakota. It's a grocery anchored shopping center that I bought from a REIT, a public REIT, that for various reasons wanted to liquidate this. And I got it at roughly a little bit over an 11% unleveraged return. And since then, fortunately, the net operating income has gone up. My debt, of course, is fixed, and things are going very well there. And even though North Dakota is getting hurt by COVID right now,
Yeah,
all the tenants are open and paying.
that's great.
Yeah.
But to address her international, I guess at VIP we do occasionally look at international deals. With Lenny, we're talking about owning a piece of real estate directly, and that's interesting because it's small. You see this basket of eggs, you truly wrap your arms around it, you understand it. With a piece of foreign real estate, you are a foreigner, and so our strategy has been to occasionally invest in securities that have real estate like that. Most recently, I was looking at Costa Rica in some of their hospitality properties that were experiencing some distress, and you'd imagine that Central American distressed hospitality during a period of an uncertain future, it would be cheap. It was not. The U.S. hospitality was just as cheap, maybe cheaper. So, and maybe it's because they have better weather. So.
That's interesting. I would have thought that as well. That would be cheaper. That would be, yeah.
But there are occasionally very attractive foreign opportunities. I remember some years ago, I was listening to a presentation of a REIT. They were talking about more attractive net spreads versus financing. Europe has cheap money too. I recently read that people in Denmark are getting 20-year mortgages at a 0% rate. I don't know that money's open to me, but
wow. I want that.
Yeah,
I'm sure everybody does.
Sure.
So let's go through, and can you guys go through like your screening, how you approach it, thoughts on along that, types of properties. Also, I want to learn more, and I think our audience also, especially with investment strategies, and it's early enough in the year to revisit portfolios. Can you walk through again, like different areas, regions, requirements, all that fun stuff, size?
Lenny, maybe expand more on this North Dakota deal, because North Dakota is not a state I think any of us are incredibly familiar with. And it speaks to the value of someone who can take something that is not known and understand it as a reflection.
Well, sure. Let me give it a try. I had never been to North Dakota prior to this, but there are some brokers who know that I will go to far-flung places. And again, this is to avoid the competition.
Sure.
So I know that I have to go probably at least 4 hours away from major metropolitan areas to get good deals. So with the North Dakota deal, it was a publicly traded REIT. It's an 80-something thousand square foot property with a long-standing supermarket as an anchor, and a couple of other public companies in there as tenants. This was, very importantly, this was in a nice, roughly 50,000 person city that was not a boom town. It was a diversified city with healthcare operations, also, of course, oil and gas exposure, but it wasn't a boom town in the Bakken Basin. There are some boom towns there that, of course, the prices went crazy, but there's a lot of risk with that, because if oil comes down and fracking becomes less important, those towns are going to get hurt. So the place where I invested has a U.S. Air Force base. It's an agricultural hub. Does have some oil and gas exposure, and also healthcare. So it's a real city, a real diversified, smallish city with good demographics. And it was just a fortunate deal that a broker who I've closed some deals with in the past knew that I was willing to travel to find a good property, and he could vouch for my credibility that with the seller, that if Lenny likes it, he really will close. It's not going to waste your time. So we negotiated a deal that worked for them, for the seller, and a deal that's working out very nicely for me.
And so what Lenny is also saying is that he started by having a network of relationships that are funneling attractive deal flow to us. They're not sending us a 5 cap, a 4.5 cap in Chicago, which is, like Lenny was talking about, more of an institutional deal. There's a million of them, and they're going to try to transact as many as they can, because they're building an empire, not trying to get great deals. So Lenny starts with something that has the return prospects to get a good deal. We're wide in the funnel. Then he's going to start to go through the tenancy and the leases. It's getting more narrow. He's talking about the town and the demographics. Is this something would I want to own something here? It's far out there, but is it genuinely attractive? He's saying it is. Gets more narrow. And then you went out and you flew there?
Sure.
How was this?
Nothing direct.
How far is the drive?
The drive would have been a couple of thousand miles.
Yeah.
It's very nice out there.
Just so we're all on the same page, we do appreciate North Dakota. It's nothing against North Dakota.
Very much so. I want to do more
Out there from North Dakota.
I would love to do more deals in North Dakota. Absolutely.
Exactly. We're promoting North Dakota. Not that I got any messages or notes from the governor of North Dakota saying, please promote us, but still.
But let's talk now about a deal that after due diligence we killed, because there are certainly going to be plenty of those. Some of the best deals are the ones you don't do.
It's good, and it's good information. I just want to also ask and mention, everything we're talking about, it's not like a listener that has not dealt with this in this world of real estate that they could just go on and start Googling. And I'll ask this at the end, but just so everybody knows that if you do have questions, you're not sure how do I approach the market, Andrew, I hope this is okay with offering this up, but get in touch with Andrew to make sure that you're approaching this market in the right way. Because if you don't, correct me if I'm wrong, you can get really burned bad on making bad investments. Which, go ahead.
Yeah, like Lenny said, and so he got to North Dakota, did that work on the ground, got through the contract work, and Lenny ultimately consummated that deal. We were recently looking at a deal in Mantic. Lenny, you want to remind reviewers how we came into this deal?
Yeah, well, so again, the broker that I've done a lot of work with in the past sent me some information on a deal in Connecticut, a few hours from New York City, which on paper seemed fine. It had a long-standing publicly traded tenant in a good space. They're a public lab. They've been there for, I don't know, 12 years or so. They had another 4+ years on their lease. I went, visited them. The tenants seemed happy in the space. And so on the face of it, it looked fine. Andrew, why don't you?
They were paying good rent. It's a lease structure called triple net. So the tenant was like taking care of the property. They're paying the taxes and maintenance and insurance. So the return is reasonably assured. There's less variance that could somehow hit us. There was a problem with the roof. The tenant just took care of it themselves. It was a demonstrated commitment to the space. They were strategically located next to colleges that they were then hiring from. So, people who wanted to be in the area who were working there. The company was profitable, has a multi-billion dollar market cap. It seemed good.
Until it didn't.
Exactly.
And then we started to get into the contracting process, and there was some language in the contracting process that really gave me pause. Specifically,
by the contracting process, Andrew means in the agreement of sale that the seller provided us.
Okay.
And it was pertaining to environmental. It wasn't part of the discussion up front. We were focused on the fact it was this ancient brick building next to a cemetery. Do they really want to be there? And the answer was yes. But then we found out at the beginning stages of due diligence, there were some environmental issues, and the broker insisted, stomped his feet up and down. This is fine. You should charge forward with this. But I wasn't so sure. And so then I continued to dig, and they had remediated some dirt. I think it was something like 200 tons of dirt, and dug out different tanks. And they were next to an oil property where they had spilled several hundreds of gallons of oil into the ground. And, it was, there was a drain in the bottom, and they used to do auto repair there. They probably just poured stuff into there. During the remediation, they found out that the pipe was leaking into the ground. They thought it was okay, but they'd have to virtually destroy the building to really know. And then I went further and I spoke to an environmental expert because they had remediated it. It technically had a clean bill of health, but started to learn about establishments, right, Lenny? Mm-hmm. And there's state-specific rules. Spoke to a guy who was one of the top environmental guys who does work for Raytheon and the defense contractor, and he took me through the establishment process and found out that the sellers were really playing fast and loose. This was likely a tainted property that needed special government designation. And their argument would have been that, well, is a motorcycle, an ATV, an auto body repair shop? Well, okay, and do I have direct evidence that this is contaminated? Well, I don't have a picture from the 50s of a guy doing something bad. And so they're making arguments, and they're structuring things so that if we found something out after the fact, it'd be impossible or prohibitively expensive to chase them down.
Yeah.
So we passed. But on the surface, this looked like one of these great investments like we had in upstate New York, an unleveraged return in the mid nines and the potential to take out leverage in the mid to low single digits.
And
So there's more to investing in real estate than just finding a property that you think looks nice and then writing a check and then hoping for the best.
well, and that's the point, because you see a lot of real estate professionals that are real estate portfolios. I know there's a couple of motivational speakers that promote their real estate portfolios and all the work they do. And you think, oh, how hard could that be when they're doing it? Like you guys said, it's not just seeing it and saying, oh, that's a nice building, let me write a check for it. There's a lot of due diligence that has to go into it to do it the right way. Because if you don't, you're going to be stuck with something that you should never have gotten into.
Yes.
And it depends how good of a deal you're going for. I can find mediocre deals all day long. But the reason it takes Lenny and I a while to do a deal is because we are literally, just skimming the top of the cream and only accepting excellent deals.
Right.
And we're putting our own money alongside, and that's, an element of it. We eat our own cook. So
That's very true. All right. So here's the one question that I'm excited to ask you, because Andrew, you and I talked about this a little bit, I think it was a week or two ago, the cannabis industry. I see more promotions, discussions about investing. I know some companies have gone public in some way, shape, or form in the cannabis industry. The real estate tied with cannabis. Can you share some insight into this and thoughts even?
Sure. And the cannabis industry is one area where you can find excellent deals to the extent that you know what you're doing. It's a complex industry. You know how to deal with the people who, many are slippery, just to be clear. And you can just gain comfort around something that is overall challenging. The returns are multiples of what you can find in a conventional piece of real estate. Difficult to source. But, we've looked at writing mortgages against real property, and as well as buying properties and leasing them to economically strong tenants. I was looking at a deal yesterday that is a first lien on a state that is expanding their program, and the mortgage would pay about 13.5%, and there were a few points up front. I think 3 points when you write it.
Wow.
And this was to a well-capitalized entity, and in the low millions of dollars for it. Now, it sounds like it's obviously a slam dunk. It's not. There is a lot to that, actually. And, just to give you an example, a friend of mine did a 3-property deal where there was a portfolio. It was 2 in California, 1 in Iowa. He started with a single owner. It was, and these cannabis people are frequently wheelers and dealers. It went to a second, and then the second owner shut down one of the facilities, went dark, sold 2 of the other facilities to a third owner, and then is refusing to pay anything on the facility that he went dark. And he's saying, come get me. And it's in Iowa.
Oh, gosh.
So the guy started with what appeared to be a great deal, and now he has a third owner who is not as strong of a payer, and one of the 3 properties is just paying him nothing, and he's just in negotiations. So it's the terms can seem really good out in the front, and but once again, an area where expertise is worth its weight in gold.
And that's a really good point, especially in an industry that most people, first dealing in real estate, most people are not that familiar with. But then you throw in this new industry of the cannabis world, and it just gets that much more complex. And without the right knowledge and resources, like you said, you can be stuck. That's got to be frustrating, I'm sure.
Yeah, we're currently structuring though a potential investment opportunity for people that would be in a fund structure. If anyone's interested in that, they should just reach out. It would be too complicated to elaborate on at this moment.
Okay, so given that, that's a great segue. And again, gentlemen, thank you for joining. It's important, in my opinion, number one, to have an advisor overseeing your portfolio. But number two, when you get into some of these investments, well, it is important for the markets and there's plenty of resources. But when you get into some of these investments outside of the traditional markets, it's incredibly important to have the right people overseeing it. And Andrew and Lenny, when you guys are talking with clients and when you're reviewing real estate and adding portfolios or structuring portfolios together, you guys are always looking out for your clients and making sure you're doing what's right for them. When they want, are there specific requirements to other levels, other types of clients that you're looking to work with?
Well, the asset minimum value investment professionals is $250,000. Under that, we provide an hourly consulting service, and then you go up to the level of accredited investor, which is a little over $1 million. You need to be what's called accredited in order to do one of these private deals with us. And then in terms of us doing what's prudent and guiding people, we would recommend that people only put in a certain percentage of their money into these things that are either more esoteric or illiquid. So, and that type of framing and judgment comes together as part of a financial plan, and it enables people to take the right risks to earn the most for their level of risk tolerance.
Perfect. Good. And as everyone can see on the bottom of the screen, if you want more information, again, get in touch with Andrew. His contact information is down there, his email address, phone number. Thank you guys again for joining. I appreciate it. And giving great insight into a world that really is not that easy to venture through. You need to have the right resources. And I know you guys are the right resources for clients. So thank you guys. I appreciate it.
Thank you, Michael.
Thank you for having us.
Pleasure.
Happy New Year to both of you. Stay healthy, stay safe. To the LinkedIn, YouTube, Twitter world, thank you for joining. And also, Happy New Year and stay safe. Take care, everyone.
Bye.